All right, I think we're good to go here. Hey, Wes, can you hear me?
Yeah, I can hear you just fine.
All right, awesome. Well, yeah, we've got quite a few people joining us here today. So, welcome everybody. We're going to have a market update, and then we're going to talk about long-term care insurance for a little bit. We've got quite a few people joining us today, so we're just going to give them a couple more minutes to get logged on. So, can you guys hear me okay? Can somebody wave at me? There we go. Thank you, Elaine. Thank you very much. Yep. Thank you, John. Jim, well, we got like 4 or 5 gyms on, so good to see everybody. So beautiful day outside. Very beautiful day. So a couple more minutes, guys. But it's good to see everybody, and good to see you, Bill, Roger, Randy. Nice. Josh, Joe, lots of gyms. Elaine, Mr. Anderson. Good to see you. Glad you're here, Carrie. Brenda, nice. Art, 2 Arthurs. Good to see everybody. Hello, Sam. Awesome. Excellent, excellent. Glad you guys took time to join us today. One more minute. There we've got some others that are logging on right now. So, all right. Excellent. Yeah, we won't take a lot of your time. It's a beautiful day. We'll get you back outside enjoying it for sure. Mr. Barnard, hello. All right, we got note taker. Let's put that on there. Excellent. One more minute, just about, guys, and we'll get going. Yeah, long-term care. Long-term care is it's a delicate conversation. Um, but the majority of people need something, some form of care. And that's what we're going to talk about today. So we're not big proponents of paying long-term care insurance premiums. We don't like doing that because that money just disappears like insurance payments. So Wes is going to talk about that here in just a couple minutes. All right. Well, guys, thank you very much. We're going to go ahead and get started. Thank you for joining us. My name is Mike Albertson, and joining with us here today is Wes. And Wes is a very, very highly skilled long-term care professional, and we completely trust him. He has written more of these policies than the entire office combined. And of course, each and every recommendation goes across multiple desks to make sure that we're not missing anything. So it's more of a team effort here. So, but thank you guys for joining us. And real fast, if you can give me the next slide, Wes, that would be awesome. There we go. Market updates. Guys, you remember back in February when the talks of tariffs started and the markets went down. A lot to be, everyone was worried. A lot of people were a little jitterish and scared. But you know what we did? We held, and we knew that it was going to eventually come back, and it did. And then we had a most recent pullback as well, with some additional language coming from the White House regarding tariffs. And had a couple people call in, not very many, and I or Apple, I've have fielded a couple phone calls on Apple, and it's like, no, we're not we shouldn't sell Apple. It's going to come back, and it has. It still has a way to go, but it is the most profitable company in the world. I mean, this company is a lot of people think it's discretionary spending, meaning when you have extra money, you're able to spend it on Apple, just like going to the movies, that's discretionary. I don't think it's discretionary spending. I think it's a staple. When people lose their jobs and their phone breaks, they're still going to grab another phone. It's just the way it is. So I love Apple long term, and just a fabulous company. But we held our ground, and markets are just a few percent behind where we were at a year ago, and I love it. we all, can argue the means in which President Trump is pushing his agenda. But some of the policies do make sense. And to me, from a fiscal standpoint, that's all I'm concerned about, not political. And I think we're gonna have a good year. The last couple quarters are going to be strong, and I think we certainly will be positive, should be positive, before the end of the year. But then again, nobody knows for certainty. I mean, from one day to the next, it's so funny. I listen to the pundits on the news channels, and markets down, they tell you why. Markets up the next day, they tell you why. Nobody knows. They're trying to stay relevant, and but nobody can tell you with any specificity which way the market's going to go from one day to the next. But I've always said this, over a long period of time, they're fairly predictable. They seem to always come up. I mean, there is a chance that it never comes back up, but it's highly unlikely that that will happen. So we are definitely long-term investors here at TradeWell Tax and Financial. But again, I want to welcome everybody. We are going to talk about asset-based long-term care, and Wes is more versed on these opportunities than we all are put together. So I am actually going to turn it over to him, and I look forward to seeing and speaking on this to each and every one of you. So it's all yours, Wes.
All right, perfect. Thanks, Mike. As Mike mentioned, my name's Wes. I'm one of the investment advisors here at the office, and he's also correct. I go through these quite frequently, and I want everybody to understand that this is not the traditional long-term care coverage that you're probably used to seeing. Those contracts are very much a use it or lose it type policy. It's not guaranteed that you're going to get your money back. So it's very much like your car insurance, your homeowner's insurance. This is not that. This is quite different. Just so everybody's kind of on the same page, I want everyone to understand the importance of having some sort of plan, some sort of care. And here's some stats. So 54% of claims are for in-home care, not necessarily to a facility. And a lot of those traditional long-term care policies don't even cover that. The average national cost for this type of care is about $8,700 a month. The average stay is about 3 years, and it's very dependent too. What we've been seeing recently is not necessarily the physical reasons for going in for care. It's going to be the mental stuff. So it's the dementia, the Alzheimer's, and that can last a long time. So we want to keep that on top of our minds as well. And then last one here, 70% of people turning 65 this year will need some form of care. And I believe that's gone up for the last time I saw that stat. I think the last time I read that, it was 64%. So it's going up. Asset protection, most people don't understand the difference between what Medicare and Medicaid are. Some people think Medicare actually does pay for long-term care, those types of needs, but it doesn't. It's just short-term skilled care. And again, the main purpose for doing these types of policies is so we don't have to deal with the spin down due to Medicaid qualifications. We don't want to have to use our hard-earned assets to pay for this care. And also too, I mean, we don't want to be a burden to our kids and grandkids. I know I've got three little boys. I got 3 boys under 3, and I would not want to put the burden on them to take care of me just because I didn't do the proper planning ahead of time. So strategy, there's 2 different ways that you can do it. And we have 2 different companies that we use depending on if it's IRA funds or if it's the non-qualified funds. So we're going to talk a little bit about both of those strategies. Everybody's going to be a little bit different. This particular contract, essentially what it does is you take a single premium, call it 50 grand or 100 grand or whatever it might be, you throw it into the contract, and this changes on your asset sheet. Most of the people that are in here are families of ours, and they come in and every time you come in, you have those asset sheets, right? So you've got your line items, okay? With traditional long-term care, that money is gone. There is no additional line item to use. In this situation, we're just moving it from this line up here to a line that's down here. Still shows up on your asset sheet. You can still get to it whenever you want. The 100 grand in this situation that goes into it, you can get it back whenever you want. It's completely liquid. You don't have surrender charges. You don't have fees. You don't have any of that. So if you put the funds into it today and you call me next week and say, hey, Wes, I want 100 grand back, you can get it right back out of it. Okay, so it's completely liquid. Now, what that 100 grand buys you is a few different things. It buys you, in this situation for Mr. John Doe, it buys you $165,000 worth of tax-free death benefit. So day one, you get into the contract, you go drive home, get hit by a bus. Technically, you have a return on investment of 65 grand. So that's going to go to your beneficiaries tax-free. Also, too, if you do need the care, which is what we're primarily talking about, it's going to give you these different types of care. So you've got guaranteed skilled nursing, you've got guaranteed chronic illness, and then you've got guaranteed terminal illness. So depending on the care that's needed, you get to also use this contract for that. So you're going to use this one in 3 different ways. Either you're gonna get your money back, and actually the 100 grand is tied to either a fixed rate, which is 5%, or a market participation, which is a little bit into the weeds, but it's going to grow. And as that grows, so does the death benefit. So you're either going to get your money back to whatever it's grown to, you're going to get that out of it, you're going to die, so you get your 165 or whatever that's grown to, that's going to go to your beneficiaries tax-free. And then also too, if you do need care, you also have this added benefit of the LTC, the long-term care or the chronic care option. There's another way of doing this, and it's very much into the weeds. And again, everybody's going to be a little bit different depending on what assets you do have. But there is a way to use retirement assets to fund a life policy, which has a lifetime benefit on it, which can also be jointly acquired. So it could be for you and your spouse, which is also, you will have the option for a lifetime payout. That one's kind of a little tricky. I would definitely suggest, if you have questions on that, to reach out to us individually. But these are some of the ways that we're able to essentially protect our assets. We're able to transfer risk away from your portfolio and move it on to the insurance company for them to help pay for care. And by no means are any of these policies that we put through going to cover the entire cost of a care need. I mean, what was the average monthly, $8,700? Most of these contracts, you'd have to put hundreds of thousands of dollars into them in order to get that payout. This is just to take care of a portion of it so that we can let the rest of the assets grow.
And I may add to this as well, Wes. So, one of the, many of our families can afford to self-pay, meaning you've got the 8,700, your asset levels to a certain point where you can self-pay. And that's the vast majority of the people that are on this call. And so with that said, what this is just simply a leverage of existing assets that in the event that something does happen, we don't cover all of it. We only cover a portion of it, but that'll help preserve the assets for our spouse and or our beneficiaries when we're no longer here. And as Wes was alluding to and speaking to, the premiums, there are no monthly premiums that we have to pay, or annual premiums. We set our money at the insurance company. They're going to make a little bit. You're going to make a little bit. If you need it, it's there, and it'll preserve the assets. And if you don't need it, that's okay. It's on your asset sheet, and it'll pass down to the next generation. So, nothing truly is lost with either one of these strategies that we have. So it's just important to understand that even though you could self-pay, this is just an opportunity that in the event that something happens, that we're going to cover about half of it. And then the other half comes from your Social Security. And so we're not draining down the assets. Now, for those of you who perhaps don't have the spare 300, and I think it's 350,000 is the average 313,000, excuse me, $313,000 is the cost for the average nursing home stay. And that's what we're trying to preserve for the next generation, and preserve that wealth for your spouse. And guys, again, if anybody has any questions, as you can see, you can get down and raise your hand or put a question in the chat box there. And then both Wes and I are certainly available for any phone calls. And if anybody would like to have a copy of what we shared with you today, we'd be more than happy to pass that on to you.
Absolutely.
Any questions?
I'm not seeing any questions yet.
Okay.
We kind of went through it quick, and these are unique. I mean, this is For a
Can
lot of you, it's probably something that you've never seen. And for the main reason behind that, and I get that question pretty frequently. It's like, well, why have I never heard about this? It's like, well, they're complicated and not every advisor is educated enough to speak upon it or confidently enough to speak upon it. So they are definitely unique contracts.
Yeah, and One America, there's probably about 3 or 4 folks that are on this call that already have a One America policy. So One America is an excellent company, and we used them many years ago for asset-based long-term care, just like what we're speaking to now. And their actuaries, I think, got it kind of wrong, and it wasn't a super profitable thing for them, and so they stopped offering it. And it truly was the best thing since sliced bread, is what I would say. It's like, and many people who have it, I'm like, this is the best thing that you have, is the opportunity, one, to pass on a death benefit, either tax-free or otherwise, and to preserve assets for your family. Well, One America came back again, and new and revised product, and it's just as good as it used to be. And we're very fortunate to be able to have them. And the Equitrust is equally as well. These are the two main players within the asset-based long-term care space. I probably wouldn't use anyone else but these two companies. We trust them, we know them. Equitrust is a 100-year-old company, and One America's been around forever as well. And it's just an excellent product. And it's certainly worthy of a conversation. Hey, Wes, can you go back to the illustration?
Sure can.
Let's just show that. So basically, there's your 100,000 going into it. You can have that money back whenever you want it. In a month, a year. You change your mind, something happens, you decide you don't care about the long-term care. You want to go buy a Corvette or something. So there's your 100 grand. You can have it back whenever you want it. Again, we're looking approximately $4,600 a month. That's going for in-home care. It's going for long-term care, adult daycare. I mean, anything that a traditional policy will cover, this covers as well. And they'll give you an option as well. If you go to a nursing home, they say, hey, we'll give you $4,600 a month, or if you want a $140,000 lump sum, they want you to take the 140,000 lump sum. We want to take the monthly benefit because it actually pays more. And then if you're terminally ill, you can do the lump sum, when you're diagnosed as being terminally ill, or you can wait, and then the 165,000, which is a higher amount, will pass down to your beneficiaries. Now, this is just one quote. We have quotes where, it covers both of you, both mom and dad, under a single policy. And it can be dad's IRA or mom's IRA, and then it'll cover actually both of you. And we also have opportunities to where, the benefits never run out. They'll be there for the rest of your life. The average stay in a nursing home is about a little over 3 years. So, but many people, this is what happens. This is what the stats show, is that when you go to a nursing home, you're either going to die really quick, okay, or you're going to be there for a long time. And there's really, the average is 3. But my grandpa was in there. You guys have heard me tell this story. He's in there for quite a few years, and he drained the family bank. And then, it broke my dad's heart, but he had to go on Medicaid, and he had to switch facilities, so, that was stressful for him. His level of care was different. And so what we're talking about here is the maybe. If something does happen, this certainly is going to help preserve the assets and make your dollars go a little bit farther. So I think it looks like we got a question here. Oh, okay, Tony, what about policies from Nationwide? I don't, Tony, I don't know of a Nationwide. Wes, do you know of Nationwide having any asset-based long-term care?
I'd have to double check. I think it depends on what line you go down and if it's a
Sure.
rider that you can add to it, but you typically have to pay for it if you
Yeah.
do.
Okay. Yeah, I hope Tony, if you could jot Tony's name down, Wes, and then just follow up with him. Let us do a little bit of research there for you, Tony, and then we'll certainly get back with you. And Dennis's question, is there a certain age that is recommended to buy into these contracts? Is the market incentives good historically right now? The earlier that you buy in, the higher the benefits are. So, I mean, if you're in your 80s, your monthly benefit's going to be less as if you're in your 60s. So, everybody that's on this call, the ages, there's never a better time to protect than now. And I do want you guys to understand as well, as fiduciaries, one, how we're compensated. Okay, so we're a fee only when and Dennis, this was a really great question. So, but it kind of leads into this. I want everybody to understand how we're compensated. So, when we manage your money, because everybody here that is our client, we have some prospects and we have some tax folks that are on this call. Our fees are structured that when you do better, we do better. You hear that on TV all the time. Okay, so typically what we charge is around 1%. We bill monthly and we bill in advance. And so what that is, it's not 1% a month, it's 1% per year. So each month it's 1/12 of 1% times whatever the value is in your account. When your account goes up, we make more money. Okay, you want me to make more money because that means you're making a lot more money than we are. So, but it also, when your account balance goes down, our fee is still there. When we take money out of your IRA or your brokerage account or your savings account, we're taking it most generally out of the market, okay, and putting it into this product. So when we do that 1% per year goes away because we don't charge a management fee on this, but we are compensated by the insurance companies. And honestly, I have no idea what the compensation is. We just started writing these, or Wes did, basically. I think I got one or two under my belt. So we are compensated by the insurance company. We have to disclose that to you during the process as well. So, so you always know that when we're switching, from the investment advisor, the fiduciary to, recommending insurance products. I want to be completely transparent with exactly how that works. So, and Elaine, on that slide, there's a maximum payout or not. On this slide right here, Elaine, there is. The maximum payout is 165,000. And this is one company. I'm not exactly sure which one this is, but the other company has an opportunity for it to be lifetime payout. So, and depending on the age and stuff, the numbers could change. This is not the highest numbers that we have. So we could have massaged this. I wanted to be right in the middle, right? Without showing, $5,000-$6,000 benefit for a younger person or showing, something extremely low. We hit it right in the middle here. So, but that's a great question as well.
There's
This
something
one,
also to add on that point too. So as that 100 grand that goes into it, that again, you can take out whenever you want, as that grows, and it should grow based on the sub accounts that are within it, as that grows, the death benefit is also going to grow, which is also going to increase your monthly benefit because the monthly benefit comes from the death benefit. So there's certain levels that, to be fall under the umbrella of an insurance policy. You can't have too much cash in it with a little death benefit. So as the cash grows, so does the death benefit. So it's
uh,
going to constantly change year to year.
that's an excellent point. It sure is. And so again, we're hitting right in the middle here because, we don't like overpromising. I don't like under deliver either. We usually right in the middle there. So, so Elaine, that's a great question. So in this instance, it's 165 less growth. And then Dennis, you have another question. So these policies set up as joint policies that cover both husband and wife, or separate policies are needed. Well, again, the one we're showing you here is single. We did not illustrate the joint policy, but I think Wes, you said the joint policy even had higher numbers than this, I think is what you
Yeah,
showed.
technically
So
it did. It was the same age. So I did a husband and a wife. I put 100 grand in it. And the lifetime payout for each person, husband and wife, was $4,100. So
it'd be $8,200 forever.
yeah, either
For
one
both
can
of
use
them.
it.
Yeah, we want guys again. We don't, we're not into the bells and whistles, it's shiny stuff. Okay. So, and these numbers are different for everybody depending on your age. Again, we're hitting it in the middle, nothing shiny, but if you're interested and, this may be worthy of a conversation. And Hannah, Great question again, and I think we answered it. So how many years, months will the benefit be paid with this illustration? Well, you just do this, the math, the 40, you get 165,000 and you divide that into the 4576. It's going to be 3 years. It's 36 months, which is the average stay of a nursing home. And with this particular policy, then once those benefits are over with, we made 65%. Unfortunately, you're in a nursing home, and then now the 4576 that is no longer paying out of this policy is coming out of your account. But we just saved $313,000 for you still have that 313 that's still in your bank account that we didn't have to spend. So that's a great, great question. Let's see. Oh, and Dennis, of course. Another question, Dennis, great question. So is the principal investment protected from losses? 100% it is. Or could it be impacted by market performance? Let me read the entire question. Is the principal investment protected from losses, or could it be impacted by market performance? Is it guaranteed to grow by 5% annually from a cash perspective? So I'm going to answer the first two questions, and I'll let Wes do the last one because I want to make sure that the answer is correct. The principal is protected from losses, and it is not impacted by market performance, of which now the earnings are. The earnings are. So if we're in the S&P 500, S&P 500 goes down, and Wes correct. You know what? I'm going to let Wes talk on this. He knows more about this than I do. So go ahead, Wes. I
Okay,
should answer this question.
yeah, I was trying not to get too far into the weeds, but since the question was asked, the 100 grand, so it's completely secure. You can get that out whenever you want. Now, what it's tied to, it could potentially be tied to two different things. There's a fixed rate, and then there's a what's called market participation rate. So the fixed rate is 5%. It's better than any CD that you're going to find. It's actually more than our money market funds. So we do have people that have CDs come due, and this makes a lot of sense just because you get a bigger fixed rate. So you can select the fixed rate, which is 5, or you can do market participation, which tracks the S&P 500 up to a certain amount. So the most that you can make is 10%. The most that you can lose is 0. And how they calculate that, let's say you start the contract today, it's June 10th, 2025. They would look forward to our next anniversary, which is June 10th, 2026, and they'll say, okay, the S&P did 15%. Well, they're only going to credit you 10. If the market goes down 15%, you're back at square one, you're at 0. So it just depends on what roads you go down. You can do a combination of the two, but the earnings cannot be affected by market performance. They take a snapshot. It's a point to point. So they look at June 10th, 2025, they'll look at June 10, 2026 and say, what did the S&P do? And then that's your new watermark. Let's say you got 10%, you capped out, you made the most that you can make. And so now your 100,000 is at 110. Now your new watermark, your new starting point is 110.
Yeah, excellent. Thank you. Next question, Mike. First off, Mike, again, once again, thank you very much for your 100 years of service to our military. I know you've been there forever. But thank you very much for that. And this is a great question. And I say 100 years, he's not near that old. But he's asking, and there's no such thing as a stupid question. If you're not 59 and a half years old, you can use IRA, you can still use IRA money or brokerage account money. You don't have to be 59 years old to take it from your IRA. So it works both ways. So, and so Mike, both Wes and I would be more than happy to sit down and talk to you, when you come in and just, give you an opportunity. We can either have a great conversation or we can determine whether or not to continue on with this. But we'll be more than happy to sit down and talk to you. So I think that's it for questions. Unless somebody else has a last second question, I think we're about done.
Yeah, got about 2 minutes.
All right. Well, hang on a second. Yep, I think that's it. So guys, I want to thank everybody for coming. You got anything additional, Wes, that you want to share?
No, I don't think so. I think we covered most of it. Again, it's just very dependent on the individual person, what your asset level is, what personal experiences you have. Is this something that you lose sleep about? If it is, we should talk about it. Even if it's not, it's still important from a planning standpoint. Again, you don't want to put the burden on your kids to take care of you. You know, I've heard 100 times like, oh, when I get to that point, just take me out behind the barn. It's like, well, yeah, that's funny, but it's not necessarily how it works. So just doing the proper planning, and we'll kind of walk you down the road and say, hey, this is where we should go. This is where we shouldn't go. This makes sense for you, or this doesn't make sense for you. Everybody's just a little bit different.
Yeah. Guys, thank you very much. Enjoy your evening, enjoy your afternoon. If anybody would like to have copies of what we just went over, be more than happy to send the slides to you. Just reach out to us, and then Tony, you can expect a follow up from one of our staff members regarding the nationwide policy. Guys, thank you very much. Look forward to seeing everybody in the office real soon. Bye now.
Take care.